Well, here in Spain, it's time to join Hanson from Blevins. How are you doing, Brett?
Yeah, I'm good, Howard, thanks. What about yourself? How's things?
Things are good. Can't complain.
Good.
So today, Brett and I are going to take a look at one particular investment asset class, bonds. They can be a popular investment with retirees as they can provide a fixed income. However, they faced a challenging year in 2022, so Brett will explain why and what the future should hold for them. So let's start with the very basics, Brett. What are bonds and how do they differ from equities or shares?
Well, Howard, bonds are also referred to as fixed income securities and are one of the main, I would say, traditional asset classes that many listeners who have investments or pensions will be probably familiar with. A bond is a loan made from one person, corporation or government to another and can be thought of as an IOU between the lender and the borrower or issuer of the bond. When the bond is issued, the terms of the bond will be outlined, which include how long the money will be loaned for and what will be the interest payments paid to the person lending the money during this term. At the end of the term, which is the maturity date, the loaned funds must then be paid back. And the interest payments are the returns that the bondholder earns for loaning their funds to the issuer. And the higher the interest rate, normally the lower the credit quality of the borrower. For example, the rate of interest you may get from, say, lending money to a very big UK household company will be significantly lower than lending your money to, say, a new startup company where the management of that company has very little experience. Corporations will often borrow to finance new projects, to buy property and equipment, to undertake profitable projects for research and development, or to hire employees. And the problem that these large organizations run into is that typically they need far more money than the average bank can or is willing to provide. And so bonds offer a solution by allowing many individual investors to assume the role of the lender. This is achieved through public debt markets, which allow thousands of investors to lend a portion of the capital needed. It also allows for these lenders to sell their bonds onto other investors or to buy bonds from other individuals. In comparing bonds to, say, stocks, a stock, also known as an equity, represents the ownership of a fraction of the corporation or company who issued the equity. Units of stocks are called shares, which entitles the owner to a proportion of the company's assets and profits equal to how much they own of the stock. And stocks are bought and sold predominantly on stock exchanges. Like bonds, corporations issue stock to raise funds to operate their business, and the holder of stock, or a shareholder, may have a claim to part of the company's assets and earnings. Shares can also pay dividends, which in effect is a reward for holding that share. And so looking at the difference between bonds and stocks or equities, bonds vary from these in several ways. For example, bondholders are creditors to the corporation and are entitled to interest, as well as the repayment of the original money loaned. They're also given legal priority in the event of a bankruptcy and will be the first to get their money back if a company is forced to sell its assets. Conversely, shareholders often receive nothing in the event of bankruptcy, implying that stocks are riskier investments than bonds. However, over the longer term, historically, owners of shares have achieved much better returns than from fixed income or bond investments. But at the same time, historically, Howard, the bond market has been less vulnerable to price swings or volatility than the stock market.
Do government bonds work differently to corporate bonds?
No, not really, Howard. Like corporations, governments also commonly use bonds in order to borrow money. Governments need to fund the building and maintenance of roads, schools, dams and other infrastructure. And the sudden expense of war or the need to provide financial support during difficult times, like during the pandemic, may also demand the need to raise money. And so governments also issue bonds, and like when lending to companies, when investors buy government bonds, they are lending a government or public entity an agreed sum of money for a specific period in exchange for regular payments at predetermined rates until maturity, until the full amount of the money lent is repaid. Government bonds, though, tend to be considered less risky than corporate bonds because, in theory, governments can print money to service their debts, and so they should always be able to fulfill the repayments when bonds mature. Of course, there have been times when countries have defaulted on paying back the money they have borrowed. I can think of Argentina, Lebanon and the Ukraine among some of the countries which have defaulted over the years, but it is rare. And because this is unusual, this means government bonds tend to pay a lower rate of interest than corporate bonds, as they're regarded as being safer.
If someone wants to invest in bonds, how do you suggest they do this?
Well, Howard, I would suggest that if any of our listeners want to invest in bonds, it's advisable that they use a professional company with the experience and skills to choose the best government and corporate bonds available, because investing in the bond market does require analysis and expertise. I have investments in both bonds and equities, and I would never hold individual bonds or shares. I'm a great believer in investing in funds which hold numerous bonds and equities, thereby significantly reducing the risk of an impact on my investments because a particular company basically going belly up. I also ensure that with the bonds I do hold, I have a good mix of government and corporate bonds which are in different geographical and market sectors, just in case one particular country or company got hit hard by some crisis, as we saw with airlines and tourism during the heights of the pandemic, or banks during the financial crisis. And so the most effective way of diversifying investments and maximizing returns is to select a bond fund or a few bond funds which are managed by expert professionals.
Do you recommend that all investors own some bonds in their portfolio?
Well, historically, bonds were bought if someone wanted an income because the payments of the regular interest provide a predictable income stream. And if the bonds are held to maturity, bondholders get back the original money they loaned. So bonds are a way to preserve capital whilst also investing for income. At the same time, typically someone would invest in equities for longer term growth because historically they have provided better returns than cash or bonds. But as investors will be acutely aware of right now, equity or stock prices do rise and fall over time, and market fluctuations can be unnerving for some investors. And so bonds have often played an important role in diversifying risk and reducing volatility within portfolios. In fact, for many decades, Howard, returns from equities and bonds have been what is referred to as negatively correlated. And this means when one moves up, the other typically goes down and vice versa. And this has been a useful dynamic in helping investors with diversified portfolios to dampen volatility and limit losses in times of market turmoil. And so when investing, whether you're looking for income or growth, your attitude to risk is a very important consideration, along with diversification. When it comes to investing, Howard, the old saying about not putting all your eggs in one basket is still very relevant. So I would recommend listeners invest in a variety of asset classes which match their attitude to risk, objectives, and their time horizon, i.e. over what period of time are they likely to be investing for in order to achieve their aims and objectives.
2022 was a very challenging year for bonds, which caught many people by surprise. So what happened with bonds last year?
Yeah, there is no doubt, Howard, that bonds have been one of the casualties of last year's high inflation and the rapid rise of interest rates. Bond values typically move inversely to interest rates, and so as interest rates rose quickly last year, bond values went down. But the sheer pace and magnitude of the interest rate rises caused bond funds to fall much more than what was initially expected. I recall quoting in one of our broadcasts just over a year ago how the Federal Reserve, the Bank of England and the Central Bank of Europe were all expecting inflation to come down in 2022 from what was at the time an inflation rate of around 4 or 5% and be around 2 or 3% by June or July of last year. But for reasons which we have highlighted in previous broadcasts, this didn't happen, and in fact inflation soared, and so central banks increased interest rates much more quickly and much higher than was originally expected. In the US, it's worth remembering that in March of last year the interest rate was 0.25%, but by December they were above 4%. And likewise in the UK, the interest rate in January of last year was also 0.25%, but by the end of the year it was 3.5%. So although normally when investors sell equities they tend to invest in bonds to protect their capital, last year we actually saw equities fall in value, but also bonds dropping in value too.
Was this poor performance across the board? Were all bonds affected?
Well, we saw the fixed income market post some of their worst returns in history. Most bonds were affected, Howard, all down as much as 10 to 16%. And so last year we saw many leading stock markets drop between 20 and 25% and bond funds down between 10 and 15%.
So the big question, Brett, what is the outlook for bonds? Do you expect 2023 to be a better year?
Well, Howard, when it comes to short-term predictions, I prefer to leave that to others to get wrong. But our investment partners have told us that they are cautiously optimistic for core parts of the bond markets, and they've also suggested that high quality fixed income now offers higher yields as well as the potential for capital appreciation if inflation recedes. Whilst last year was a bad year for bonds, it is felt that over the medium to longer term, bonds can revert back to being a reliable alternative to equities, as they have been for many decades, especially during periods of turbulence in equity markets. It should be noted that certainly since the late 80s, global bonds have consistently provided positive returns during the most severe global equity downturns, including the global financial crisis and the COVID-19 pandemic.
Overall, Brett, how do you help clients reduce investment risk?
Well, Howard, the majority of our clients are retired, and we understand that their first priority is to preserve the capital that they have worked hard to accumulate throughout their lives. We find clients are not generally looking to shoot out the lights when it comes to performance, and so the starting point whenever someone is investing, and I've touched on this earlier, has to be to obtain a clear and objective assessment of their appetite for risk. And once we've established a client's attitude to risk and their objectives, we can then allocate the right amounts of the portfolio of investments to the right asset classes. When it comes to investment research, we have our investment committee, which is supported by our investment services team, who are tasked with continually reviewing our investment portfolio proposition. They monitor the performance of our various portfolios and are in constant dialogue with the various fund managers we work with in order to ensure that our clients are best placed in order to achieve their objectives. Part of this process, Howard, is to ensure that our clients' money is invested in appropriately regulated funds with the world's best investment managers in their relevant field of expertise. And of course, this is just the start of the process, Howard, because in conjunction with this, our services extend to providing tax-efficient solutions and estate planning for our clients who are living or moving to Spain. So in addition to creating the most appropriate portfolio to meet their investment objectives and attitude to risk, we also need to find the most appropriate structures to shelter their capital from the taxes in Spain, and of course to facilitate the transfer of capital to their chosen beneficiaries with the minimum bureaucracy and inheritance and succession taxes. Of course, Howard, if anyone would like to get in contact with one of our fully qualified and fully regulated local advisors who live and work in the same jurisdictions as our clients live in, they can go to our website and find the location of their nearest Blevins Franks office.
Finally, Brett, we have some changes coming up with our weekly discussions.
Yes, Chris McCann and I have been sharing these weekly radio discussions for the last couple of years, and we would like to introduce to our listeners over the next couple of weeks a couple of other partners who would like to participate in these broadcasts. Paul Montague has been with Blevins Franks in Spain for over 20 years and has a great deal of experience advising British expatriates here. He was based in Tenerife from 2003 to 2021, but is now on the Costa del Sol. We've also got Cathal Rochford, who has been advising Blevins Franks clients for many years now, initially on the Costa Blanca, but now in the Balearics. Chris and I will continue to do these discussions too, but what we'll do is that we'll be rotating the weekly broadcasts amongst the four of us.
They say variety is the spice of life.
So they say.
Thank you very much, Fred. We'll talk sometime soon.
Yes, Howard. Thank you very much. Take care now.